Hi everyone! Welcome to today's fun learning session. I'm Ursa Nurwit-Asari from the Accounting Education, and I'm so excited to be your guide today. In this video, we're going to explore one of the most important topics in accounting for merchandising companies: posting transactions into the general ledger. Don't worry, we'll break everything down step by step, in a way that's simple, clear, and enjoyable to follow. You'll learn what a ledger is, why it's such a big deal, how journal entries flow into ledger accounts, and how the perpetual inventory system keeps everything updated automatically. By the end of this session, you'll understand the process, you'll feel confident doing it, and you might even say, "Hey, accounting is actually fun." So sit back, stay curious, and enjoy this journey with me. Let's get started and make accounting come alive together. Let's begin with the basic question. What is a ledger? A ledger is a complete collection of accounts used to record and summarize financial transactions. It organizes all business activities into categories such as assets, which are things the company owns; liabilities, which are things the company owes; equity, which represents the owner's rights; revenues, which are the income earned; and expenses, which are the costs incurred. Each account in the ledger shows increases and decreases, usually in the form of a T account. On the left side we have debits, and on the right side we have credits. Then what is the purpose of the ledger? The ledger helps companies understand their financial position clearly, and it's the foundation for preparing financial statements such as the balance sheet and income statement. Now, let's look at the context of a merchandising company. Unlike a service company, a merchandising company purchases goods, stores them as inventory, and sells them to customers. Because inventory constantly changes, many merchandising companies use the perpetual inventory system. What does perpetual mean? It means inventory is updated continuously. Every purchase and every sale is recorded instantly. For example, when goods are bought, inventory increases. When goods are sold, inventory decreases and cost of goods sold increases. The perpetual system allows managers to always know how much inventory they have at any moment. Now let's break down the posting process into clear and simple steps. First, identify the source document. Before recording anything, always check the evidence such as invoices, receipts, purchase orders, and cash documents. Second, analyze the transaction by determining which accounts increase or decrease, and deciding whether each account should be recorded as a debit or credit based on accounting rules. Third, record the transaction in the general journal by writing the date, debit entry, credit entry, amount, and a short explanation, and assign a journal reference number such as J1, J2, or J3. Fourth, post from the journal to the ledger by opening the related ledger account, transferring the amount into the debit or credit column, writing the date and journal reference, and updating the running balance. Fifth, perform cross-referencing by writing the ledger account number in the journal and the journal reference number inside the ledger, creating a complete audit trail that helps trace or avoid errors. Sixth, calculate the ending balance after all postings are made. Finally, prepare the trial balance by transferring the ending balances into the trial balance to ensure that total debit equals total credit. Next is an example. Before we delve into the examples, let's learn how to fill in the columns in a general ledger. To fill in the columns of a general ledger account, we start by entering the company name and the period. Then, we'll write the account title at the top of the page, followed by the account number. Each transaction posted from the journal is entered chronologically. In the date column, we record the day the transaction occurred. Next, in the description or explanation column, we write a brief note summarizing the transaction. Then, depending on the journal entry, we record the amount in the debit or credit column. After entering the debit or credit, we should update the balance column on the right by adding or subtracting the amount based on the account's normal balance. This running balance helps users easily track how an account increases or decreases over time. By completing each column carefully and consistently, the general ledger provides a clear and accurate record of financial activity for that specific account. Okay, because earlier we learned how to fill in the columns in the ledger, now let's go into discussing examples. Let's look at a complete example using a perpetual inventory system, PT Mekarsari in January 2025 had the following transactions. On January 1st, there was a cash purchase of inventory for 5 million rupiah. On January 3rd, an inventory purchase on credit for 8 million rupiah. On January 5th, a payment to a supplier for 3 million rupiah. On January 10th, cash sales of 6 million rupiah with a cost of goods sold of 3,500,000. On January 12th, credit sales of 4 million rupiah with a cost of goods sold of 2,200,000. And on January 20th, a customer paid 2,500,000 rupiah. After recording these transactions to the general ledger, the cash account records debits of 6 million for sales and 2,500,000 for customer payments, and credits of 5 million for cash inventory purchases and 3 million for supplier payments, resulting in an ending debit balance of 500,000. The inventory account records debits of 5 million for cash purchases and 8 million for credit purchases, and credits of 6 million for cash sales and 4 million for credit sales, resulting in an ending debit balance of 3 million. The accounts receivable account records a debit of 4 million for credit sales and a credit of 2,500,000 for customer payments, resulting in a debit balance of 1,500,000. The accounts payable account records a credit of 8 million for credit purchases and a debit of 3 million for payments, resulting in a credit balance of 5 million. The sales revenue account records credits of 3,500,000, 2,200,000, resulting in a final credit balance of 5,700,000. While the cost of goods sold account records debits of 3,500,000, 2,200,000, resulting in a total debit balance of 5,700,000. These ledger balances are then transferred to the trial balance to verify that the total debits equal the total credits, and in this example, they balance perfectly. Before closing this lesson, let's quickly discuss common posting errors and how to fix them. One common mistake is posting the wrong amount. The solution is to make a reversing entry and then post the correct amount. Another error is posting to the wrong account, which can be corrected by reversing the incorrect posting and recording a new, accurate one. Sometimes, students forget to post the journal entry entirely. In this case, checking the folio references in the journal helps. Any entry without a ledger number still needs to be posted. Another issue occurs when the trial balance does not balance. This usually requires checking for addition errors, skipped postings, or transposition mistakes. Posting is not just about transferring numbers. It ensures accuracy, reliability, and completeness in all financial statements. To summarize, posting is the process of transferring journal entries into the ledger, allowing us to clearly see each account's activity and balance. In merchandising companies, accurate posting is essential for tracking inventory, sales, and the cost of goods sold. A ledger itself is a collection of accounts used to record all changes in financial activities. And because merchandising companies purchase and sell goods, the perpetual system is especially useful since it updates inventory continuously. Key accounts involved include inventory, cash, accounts receivable, accounts payable, sales revenue, and cost of goods sold, and all transactions must be posted correctly to maintain accuracy and reliability. Understanding the ledger is important because it connects every transaction into one complete financial picture, helping businesses monitor performance and prepare financial statements effectively. And that brings us to the end of today's learning journey. Before we close, let's take a moment to reflect on everything we've explored together. We started by understanding what a ledger is and why it plays such an important role in recording financial information. Then we looked at how merchandising companies work, especially under the perpetual inventory system, where everything is updated in real time. Pretty cool, right? We also learned step by step how to post transactions, from identifying source documents, analyzing accounts, recording in the journal, all the way to posting in the ledger and preparing the trial balance. You now know how to track cash, inventory, sales, expenses, and many more accounts just like a real accountant. That's an amazing skill to have. If some parts still feel confusing, don't worry. Accounting is a subject that becomes easier the more you practice. You can pause this video anytime, replay the examples, or try creating your own transactions and posting them into T accounts. The more your hands work, the faster your brain will understand it. And remember, posting isn't only about numbers. It's about telling the story of a business. Every debit and credit helps us understand what the company owns, what it owes, how much it earns, and how healthy the business really is. You're not just moving numbers. You're reading and building financial information that matters. Before we close, I want to give you a little challenge. Try to create 3 new transactions, record them in the journal, and post them into the ledger. Then check your ending balances. If you can do that, congratulations! You're already mastering the basics. Thank you so much for joining me today. I hope learning with me has been helpful, fun, and inspiring. Keep your curiosity alive, keep practicing, and never hesitate to explore more accounting topics. I'll see you again in the next learning session. Stay motivated, stay confident, and keep shining. Bye-bye, everyone.